Well, good day, traders. Chris Weston here, Head of Research at Pepperstone. And we're going to take a holistic view, all the trading considerations that we look at to get us a real complex oversight of how financial markets are tracking and what we may need to see for the new trading week that will be. But let's take a step back first of all and have a look at how G10 and major currencies have fared against the US dollar this week. You can see at the top of the pile there, the Brazilian real has done really nicely, up 1.9% against the US dollar. You start going to some of our EM currencies like the Mexican peso, up 20 basis points, Singapore dollar up about 9 basis points. But it's been the yen that's stood out really well. We've seen dollar yen down about 1%. Obviously, that's been a reflection that the data flow in the US this week has been pretty poor. Obviously, people getting smacked in the face by that manufacturing number, the worst in a decade. The services ISM number, obviously pretty low, especially the employment component coming out the lowest level since 2014. People are saying that we've seen a slowdown around the world, and certainly the US is now showing that they're not immune to that situation at all. So the dollar's come under a little bit of pressure, and we'll talk a little bit about the interest rate markets in a minute. But certainly on the bottom of the pile, you've seen the Swiss franc down about 76 basis points against the US dollar. You can see the krona in Sweden down 71, and you can see the CAD obviously being buffeted around by what's happening in the crude complex, down about 0.6% there. So obviously following in with the NOK. I think it's been interesting to have a look at dollar Korea. We always look at that as a proxy of risk appetite, and dollar Korea, as you can see from the chart, looking to maybe take a test up to that triple top around 1220. If it takes out that level, I think that's going to show just the deterioration in risk appetite. I really like looking at dollar Korea as a kind of proxy about what's happening in the risk sentiment. A lot of people do look at Aussie yen, but I think dollar Korea is a really interesting one. Actually, if you go into other asset classes as well, you've seen equities buffeted around. There's certainly been high volatility. You've seen that in the VIX trading into 20%. It currently sits a little bit lower at the moment, 19%. But I really quite like the idea of looking to fade the S&P into the gap around 29.38. I think if we can get into those kind of levels, I think that would be a really good place to, obviously depending on how price reacts, and that's what you're trading. But I wouldn't be surprised. A little bit of a squeeze in that S&P just into that 29.38, where we'd be looking to see a reversal. And if it comes off, then I'll be looking for shorts there. But if you have a look at the quality of what we've been seeing, we've seen small caps really underperforming large caps. We look at the Russell versus the S&P there, and I think that's a really good barometer, because I think if that continues on its downturn, underperformance from small caps, that's going to be quite poor for risk sentiment more broadly. You've seen the cyclical sectors really underperforming against the defensive sectors, and if you look at the ratio here, you can see that the lowest levels, or looking to take out those lowest levels since August. We've seen a really strong move in the front end of the curve. Obviously, that's been a reflection of the risk appetite, but also people pricing in more aggressive rate cuts from the Federal Reserve. Two's really working nicely on the week, down 24 basis points already. That hasn't necessarily shown a significant headwind for the US dollar. It's probably played more into dollar yen than anything else, but certainly we've seen that real steepening of the curve driven by that outperformance from twos versus tens. And I think if that continues to be the case, and we see that 2-year yield trading from 139 into, say, 130 over the weeks ahead, that's going to see a continued steepening of the curve, and I think dollar yen's probably got some downside in that situation. We're also watching what's happening in inflation expectations. I think this really has to be on your radar at the moment. Have a look at European inflation swaps at the moment, currently trading at 111. This is a record low. The ECB are not going to like that one little bit. Have a look at break-even, five-year break-evens in the US. The Fed look at this pretty closely. Sitting at 168. If that goes in the week ahead, I think the dollar could come under pressure. How do we trade that though? When the fact is when you're looking at the dollar, there's not really a lot of attractive currencies to trade that against. Hence, we're not seeing that massive downflow. And people really don't want to be short the US dollar in a situation that they don't have real conviction, because obviously the positive carry or the negative carry that's involved in holding the dollar, you're going to be charged for doing so. So we've looked at that. I think they're the assets that I really want to look at in the week ahead. But have a look at interest rate markets just to get you set for the week ahead. Now, I'm saying this before non-farm payrolls numbers, but if you have a look at this really interesting dynamic in the upcoming meeting, have a look at from the second from right column, the probability of a rate cut coming at the next meeting. The Fed now 85% chance that they come and cut rates. We've seen Richard Clarida, the vice chair, speaking through Asia today. He hasn't given us an indication really about kind of whether they're going to be cutting or whether they're going to be looking to do anything with policy, to be fair. But his comments have been quite dour, and they've really reinforced the idea that whilst he refrained from actually mentioning cutting rates, I think he's given us a pretty clear indication that the market pricing is pretty much on point there, and 85% seems fair at the moment. Then you've got what's happening in Japan. Have a look at that, 84%. We haven't seen a rate cut or any kind of easing from the Bank of Japan on the deposit rate, for a number of years. And I think the market's saying here that they expect action from the Bank of Japan. The RBA now 50-50. We'll have to see how that lies. But then if you go further out the curve and have a look at what's priced in over the next 12 months on the swaps curve, you can see the dynamic that's playing there amongst these central banks. The ECB, obviously, you can see there's a small chance of a hike. They're not obviously going to hike, but I think the market's telling you that they've pretty much exhausted what we're going to see on the deposit rate there as well. So I think that's just a real reflection of what we got. We've got the RBNZ in November, expected to 100, that's a lock on, and you can see the rate dynamics playing through. But I think in terms of the Fed are expected to cut rates. What's going to change that? Well, let's have a look at the data flow as we go through the new week. Well, in terms of the US, there's not a lot. I mean, we've had so much data throughout this week that as we go into the new week, there's not really too much. The Fed minutes come out early in the week, and probably the linchpin which we're really looking at is the CPI numbers. Obviously, the Fed look at core PCE, but the CPI numbers are far more markets are far more sensitive to that CPI number there. We've got a whole plethora of different Fed speakers coming through. Charles Evans, who has now switched to a more dovish tone, he was saying that everything looks pretty hunky-dory, but now he's saying that he wants to see more action. Jerome Powell, the Fed governor, obviously the chair, will be speaking twice through this week. We've got Kashkari speaking, the ultimate dove on the bank. Loretta Mester speaking, and then you've got Rosengren speaking as well. So we've got a number of Fed speakers, but will they influence that pricing, which is nearly fully discounted there as well? I'm not so sure. So we haven't really got that data that's really going to talk about whether or not we're going to accelerate this idea that the US could be looking into tougher times. If you look in Australia, we've got NAB business confidence and Westpac consumer confidence. Remember, the Reserve Bank themselves see a gentle turning point in the economy. Will that reflected in the consumer data and the business confidence number? Will we see a slight rebound in those numbers there? And we've got home loan data as well. Whether the Aussie is going to be too sensitive to that, I'm not so sure. The Aussie has been really sensitive to the Hang Seng. The correlation coefficient between those two markets very, very high. So if you're trading the Aussie dollar, you're looking much more closely at what's happening in some of the Asian markets there to drive. Have a look at China. I think that's going to be an interesting one. We do have the credit data coming out. We get the new yuan loans are expected to tick up to 1.35 trillion. Obviously, the M2 money supply should increase by about 10 basis points to 8.3%. So suddenly we're looking at aggregate financing. So, we are seeing that credit impulse in China moving a bit higher. Japan, well, I don't think there's really going to be too much that's going to really materially change the yen. I think we're looking at current accounts and the weekly fund flows. But the yen is a vehicle for trading volatility, predominantly as a safe haven beast there. So that's one we're looking at. But the fact is that you do have a bit of a Kuroda put in the market there. The market is saying that they're expecting the Bank of Japan to ease. So, actually in that situation, the yen is somewhat supported from that perspective as well. In Europe, we're looking probably more at German industrial production numbers, but I've got my eye very firmly on what's happening inflation expectations there as well. So the data flow is generally quite light. I think you've got to look at the top-down macro situations, those big macro picture thematics. Of course, the high-level trade talks take off this week between China and the US. That is going to be the dominant thematic. So we're back watching dollar CNH, we're back watching the daily fix. We're watching things like soybeans and those factors as well. Are they showing signs of convergence? And if they do, how much do we believe that they're actually telling the truth? And we are going to see maybe even an interim trade deal coming through. We've got our eyes firmly on any kind of Brexit narrative. The pound has held up fairly well this week. We know that Boris Johnson's delivered a plan to the Parliament and also to the EU. But the EU themselves, certainly the Irish, are not overly happy about that. But there's a starting point, and can we see that being tweaked to fulfil and compel the Europeans, not let alone the UK Parliament? So certainly the pound's going to be somewhat sensitive to that. Now let's have a look at what's happening in the implied volatility space. You can see here from the table, which you get on the daily fix, which I post out, just that cable now in terms of the at the money weekly implied volatility trading at 10%. So that's now got the highest implied volatility of G10 currencies. Aussie yen, we're always expecting a slightly high relative Aussie yen implied volatility. But if you have a look at them as on a percentile rank, how this implied volatility stacks up over the last 12 months, they're not particularly high. I mean, even if you go down to dollar CAD, that's trading at the 19th percentile. So where we've seen this higher volatility regime playing out, certainly in the bond market and certainly in equity markets, again, You know, we haven't seen that playing out in FX markets. Why is that? All central banks are looking to ease. The market's feeling pretty happy about that. That suppressed volatility in the FX market for me. But you can see here the expected moves. Now, we use this as a guide. You can see the ranges that are coming through based on the straddle pricing. So 157 points either side, up or down in cables are what expected. You can see that implied range 124.94, 121.80. I like to use this as a guide for where the market sees sort of the expected moves with a 68.4%, 68.2% level of confidence that it won't breach this level. I like to use this as defining my risk. You know, if we're taking 157 points in cable, you know, I'd like to use this more than the ATR because it's forward looking. But we can see the difference between realised volatility, some of the measures that you would have been looking at relative to what the market's looking forward. So we lose at the money implied volatility because the market is taking into consideration everything they know, whether it's Brexit, whether it's high level talks between US and China and all the data they talked about, and obviously all what's going on in the US economy and the idea that we are closer to a recession. Certainly that's what the curve's been saying. And you can use that guide there just to talk about the expected moves up or down and use that to define your risk. I think that's a really good way to do it. But again, we go into the new week. We're still answering a lot of questions around whether, you know, the implied probability of a US recession over the 12 to 18 months is higher than what the market's forecasting, about 30% at the moment. What does that mean? And do central banks generally have the firepower to deal with that? As we've seen from the rates markets, they're continuing to expect very aggressive rate action from these banks.